Hey everyone, this is a video that's going to be somewhat of an aha moment to a lot of new people to credit spreads, and it's basically touches up on what to do when one goes wrong. So I will approach it from, this is a real life question that just popped in from the chat room, came in from the chat room. They were kind enough to let me use it. I'm not going to say who they are. They didn't do anything wrong. I'll just share how could this have been a little bit better and how I would deal with it now. So the stock in question is ROKU. It's down 11% today after being down so much on something. Somebody must have downgraded it from super buy to less super buy or less better than hold, switch it. I know I'm just making fun of how they rate things, and most likely their price target on it is still higher than current price. So, but that's how Wall Street works. So we have to play with what they do. So first, chart comments. I've said that it's a catchable knife, but I would stop out fast because this is a neckline that needs to hold. One last ditch effort. I put a note here, overnight from 1103, and last ditch effort. It's been there for a while. Okay, so I want you to look at this line right there. I drew months ago how it was penny perfect where this came. The quote headline broke out exactly at where that penny perfect line is. These are not coincidences. You can believe me, you don't want to believe me, that's fine, but they're not coincidences. They play out. In fact, this right there is penny perfect to this candle right there and area here. And let me see where it is right now. It's where it should find support, but it's a wide zone. So comments on the chart. I said it's a catchable knife. This earnings dip was a catchable knife, but I would stop quickly because of if they lose this last ditch effort, they continue this broken down neckline from up here. Okay, so unfortunately they decided to do that. So now the chart should find support, but unfortunately it's a wide band. In fact, I had already put on the chart, I did not add this today. Be careful, could go to 220. In fact, in my videos, recaps from this weekend, I believe either that or in the write-up, I mentioned 190 to somebody, if not everybody. So technically, this zone is doable with a lot of support in between. If the markets fall, continue to fall, or have a tizzy, 2 to 3%, 1 to 2%, this one might finish the job down to 220. And it is catchable here. If I'm long, I don't add. If I didn't learn anything new today, somebody's opinion doesn't matter to me. If it falls to 220 or 190, maybe I would be tempted to add, but I don't like to add to mistakes or at least problem trades. All right, so what was the trade? The trade was, I'll show you, I'm glad you asked, this was it, a credit put spread at 280. They did that on 11/8. Let me take the lines out now that we know. Here. So they weren't wrong. They looked left and they said, I'm saying that it's going to hold. So they were emphatic about it and they took a long and they didn't leave any room for error. What do you mean, Nick? Okay, so the trade they chose is a credit put spread at 280 and it paid them 250. I'm rounding. They collected 250 right off the bat. It is $5 wide. So therefore by definition, they have a coin flip odds because they said it's not going to fall anymore because the only way this wins is if it stays above 250, 280. And that was the price then. So they left absolutely no room for error on 11/8. Let me see here. It was right there at 280. That's why they collected a little more than 250. The market makers are not idiots. When they give you half the bounty, they expect you to have a coin flip outcome. Guess what? He's saying now it's down. Of course. It's not $5 yet because there's still plenty of time on the clock. They chose, luckily, not this week's contracts. Smart, because that would have paid $250 also. They chose end of December, 23rd. So they have time. So one bet pop and they could be out of trouble. Here's the thing I would do. First of all, if I do get the pop and I go back to even, I take the trade off. Why? Because when I take a trade, I want edge. I want to have the odds in my favor. When I collect 250 on a $5 wide spread, let me show you what it looks like again. If I had collected 250 on a $5 wide spread, I don't have an edge. $1 lower, I'm in trouble. $1 higher, I win. That is not edge. Edge is collecting $1 on a $5 wide spread. Then I have odds, like 80% odds in my favor. If I collect 50 cents, I have like 88% odds in my favor. So I collect less money, but I have at least a chance of winning. All right, right now it's worth $4. The stock must have just taken a little dip lower. So the risk from here is they could lose another 80 cents in this case. So they've lost already 250 minus 420. It's not a big deal. They could lose another 80 cents. So what should one do? If I get a pop and it goes back close to 250, I would close it. That's number one. If not, I wouldn't panic, close it today, because I'm willing to risk that 80 cents to see the next couple of day outcomes. And this is a manageable trade because of time, because it is December 23rd. So in essence, there are, how many days left? 36 days on the clock. It's not going to likely fall another 11% tomorrow. And if so, this won't go to 5 because of that time. Okay, so I have the panic time is over, and now it's in the muck. Price is gone past it. This is current price right here, and this is the problem. So you need this price to move back up for this value to drop back to 250. This trade can still win if in the next 36 days ROKU meanders higher and closes at or about 278, 277.5. They would break even, but I wouldn't wait for that and hope for that. What do? I wouldn't add to it. I wouldn't sell a credit call spread now. I would simply wait to see another tick because I'm only extra risking another 80, 90 cents. I could take it off if it hit my limit. What is that limit? If I cannot see more than 30% loss or more than X dollar amount loss, then I should get out. Their thesis was it wants to hold the floor. Their thesis was broken. So in theory, they should close the trade. It was a trade, not an investment. If so, and if so, then they should close it. They said that level is going to hold, and it didn't. So that thesis was broken, that one. So one candle, maybe they want to see another candle. So that's where the decision comes in. The loss, luckily, is 250 minus 4. So $1.50 per contract. That's what they lost now. Because if they go to close it, they have to buy it. And the current price is $4. They only collected $2.50. The difference is their loss. Their maximum loss is another $1 because they collected $2.50 and they can only lose $2.50. That's why it's a 50-50 coin flip trade from design. When I sell risk, I usually go lower and collect less. I risk more money at risk. I put more money at risk, but at least I put the odds in my favor. In this case, they had a thesis that it's bottomed, so they took a 50-50 shot. That's why I said they didn't make a mistake. That was the thesis, and they were wrong. It broke. So now they're saying, help me with this trade. It's red. Yes, it is, because your thesis was broken. So the decision is, what do I do with it? Currently, in my hands, I wouldn't do anything until I see another tick or two, personally. Because I lost this much, I'm willing to risk another $1 or 80 cents or whatever it is. It's probably going to be another 50 cents if it drops again tomorrow, a little bit, not that much. So I'm willing to risk it another day. I would not add to it. I would not sell a call spread right now to balance it out. It's too late. So this is the predicament. Some people say, well, can I roll it? Sure. Quote, rolling is closing the position here and opening it somewhere else. So rolling would involve 4 legs. So they would add 2 of these, and then they would do the same thing. Say if they want to roll it in January, they will reopen it in January. So they would be buying it to close here, buy this one, sell that one, and then Sell this one, buy that one. Sell the 290, oh, sorry, the 280 and the 275, same one in January. And look, the cost will be about the same. Slight debit. What does that do? It books their loss here and it reopens the same trade out in January. I would not do that right now because I don't know anything new. Why would I want to pay more money to stay in the same problem, only with more days on the clock? Time is not running out. I still have 36 days. I would not do that right now. But that's rolling. I close it here and reopen it out in time. In essence, I book a loss and reopen a fresh trade. That's what quote rolling is. I would not do that right now. So to recap, somebody came, uh-oh, I'm in trouble. I have a trade up here, credit put spread that's been engulfed. Price fell 11%. I said, how much should you collect? They said 250. Whoa, right there. I know they were saying that's the bottom because otherwise, why would they take a trade at the money? That's 250. That's half the bounty. That means the price was at the money. Price was 280-ish. So they lost. They should close it for a loss. If they don't want to, they can wait another day. They have time on the clock. The good thing they didn't do it in this week. Then their backs against the wall. This would be fully engulfed, and it would need a miracle for them to make any money out of it. Let me see here. What did we say? 280, 275. See, it's almost $5 already because there's no more time. There are a couple more days. So there's very little chance it's going to bounce all the way to 280 today, tomorrow, or the day after. So the market makers will give it full loss. So because he chose wait out in time, he still has $1 left. It's only 4 for his in November 23rd. See how it's dropping the longer I go out in time? Watch. December, I get closer, it's 440. I get closer, it's 445. I get next week, it's 465. This week, it's $5 almost. That's maximum loss. So I go out to December 23rd. It's under 4 now. So Roku is bouncing a little. All right. So that is what I would do with it. And this video, if you don't have that trade, you just saw a great lesson on credit put spreads and setups. Why I take a humble premium to give myself the odds so that I can absorb a 10% drop and still be out of the money. But the risk is I put more money at risk for those higher odds. Because if I only collect $1 to begin with, then I'm risking 4. He only risked 250, but he didn't have any edge. He was at even playing field with the bear. Bulls and bears have a 50-50 shot at any point in time if they buy or sell the stock right here. I give myself edge by taking the bet much lower in my favor. So I would need another drop to lose money. Okay, hopefully that helps people.